pretty high level, if everyone's okay with that, only because the moment we start drilling down, we go down a complete and utter rabbit hole. But Q&A is probably the most interactive thing to try and make it really relevant to where you are today. So please don't hesitate to ask questions. So I'm Sharon Cook from Choice Business Loans. I have been doing this job for too long. I was actually looking at my grey hairs this morning. That's how long I've been doing it. And we've been established ourselves for 13 years. So we know the marketplace really well. We're very small, very bespoke, and we work very individually with our clients. So keeping this nice and high level for you, what is the marketplace today? Well, obviously we have interest rates, base rate at the moment of 5.25. So we're starting very often at that point, which makes it difficult for everyone and makes it more expensive. But I don't want everybody to think that funding is expensive, because I've been having quotes coming out at 9, 10%. So really quite good for business rates. And they are really keen to lend, is all I can say. Money is sat there desperate for a home. So it's really important that you don't get put off by the fact that money is expensive at the moment. So if you go to the right place at the right time for your business, you'll get the right finance. So there are things for startups. I'm going to start with the startup. So we have the Startup Loan Company, which is the British Business Bank, the best value money around. Now, a startup for the British Business Bank is anything trading under 3 years. So it's gone up. It used to be 2, it's now under 3. The reason you should think about this, if you're not older than 3, is really it's at 6%, it's over 5 years, it's repayable early, and it's flexible. The only downside is the maximum you can get is £25,000 per director to a maximum of 4 directors. So it gives you a really good scope as a startup business, and you can be pre-revenue. What this does for you is it gives you that stepping stone when you start your business, rather than putting your house on the line, which you can do, of course. Everyone can do that, and you can get money through that way. But this will give you the stepping stone from having your idea, like Phil was saying earlier, and getting it to a point, and then getting it to the next stage, and maybe getting it to that next stage where you're going for equity or that type of thing, because there's always that bridge between business if you haven't got if your traction's too big or if your traction isn't quite big enough. So let's talk about equity for a second. We've got crowdfunding. Now, people like, I don't know if you've heard of Snaffling Pig. They do the pork scratchings. Really, obviously not great for your health, but really delicious all the same. Bit early for them right now, but really nice. So they've done a number of rounds of crowdfunding using people like Crowdcube, Seeders, etc. So it's always worth thinking about crowdfunding when you're in a young age, because if you've got a product like Phil was talking about earlier, and people like that product, they will buy into the product. If you're a boring finance broker like myself, no one's going to fund you. Okay, so you have to be quite careful about who you go, where you go, and why you go somewhere when you're looking for equity funding. You have to engage with your audience. It's really important that you do that. But there is a lot of money out there, and there's a lot of support for the right kind of products. The only thing I'll say about that type of crowdfunding is you really have to have a social media mass before you start, because how do you communicate your message? You don't just go onto a crowdfunding platform, put your idea up there and sit there. That's not what you do. And you don't get funded that way. You have to be really proactive, going out there, getting the money in, getting private investors in as well, and getting everybody onto that platform. But it's definitely out there, and it's definitely worthwhile considering in early stage of your growth. Now, if you're making sales and you're growing quite fast, you can also do, I would call it cash flow forecast led lending. And that's often with a CDFI. So local funds will help you grow to the next level, even at an early stage of 2 years. But you have to be making money. You don't have to be making profit, but you have to be making sales. So you can be making sales and losing money all at the same time, but you have to be making those sales to a certain level. And that money is quite positive money. Again, it's kind of come from the British Business Bank. It's more expensive, around 15%, but you actually get people that come in and help you grow with your business and help you on the way as well. They don't just give you the money and leave you. So it's quite an interesting space to think about. Whilst it's expensive, you're not giving away the equity of your business. And a lot of us would like to keep that equity within our business. Some of the regional funds do have an equity arm that runs alongside their debt arm, but it's what I would describe as a coupon return. So they give you the equity into your business, but they want that money back after 3 years as a bullet repayment with interest, or 5 years, whatever it might be. But it's quite a nice way of building your business without giving your business away as well. But again, very much cash flow forecast led, no hockey stick curves, and all based on really good sales. So Phil started taking off and he was selling into JML or John Lewis, etc., etc. It'd be that type of thing that they would support in those two ways. But I would always suggest at any startup age, under 3 years, unless you are totally positive, try and keep your house off the line, and try not to use your house as security or collateral at that stage. You are considered high risk, and that's what the marketplace looks at. Other things to consider are things like asset finance. Who don't mind if you're a startup, you might pay a bit more, but asset finance, they're really securing it on the asset rather than on your business. They still need to see that you can repay. But if you were to go out and buy a piece of machinery, then that would be their security. So if it all goes wrong, it still belongs to them. They take it back and they resell it. So it's a really good way of getting relatively cheap funding rather than putting cash into something and keeping the cash flow into your business. So they are really good things for startups. The other thing to look at and be warned about is e-commerce funding. Amazon and PayPal are not your friends. I love them to bits, but they're not your friends. They will give you money really cheaply, but they want it back really quickly. So I had a conversation with a large business the other day that had taken £200,000 of PayPal funding. They are now in trouble because PayPal are taking that back at over £25,000 a month. So what that's done is it's had a negative effect on their cash flow. So it might have been cheap funding and they might have been looking at the price, but paying something back really quickly is really detrimental to your business if you don't have the cash runway within there. So it's worthwhile just thinking about that when PayPal and Amazon talk to you and they say, don't worry, we'll take the money at source so you don't even have to save any money up for yourself. All of a sudden, you have no money coming in from those streams because it's all going to pay back the loan that you've taken. So just think about that when you're being offered money. How can my business afford those repayments? So I often talk to my clients about cost, affordability, and length of time. So it's all very well saying I've got a 3% loan from Amazon and everybody going, well, that's really good if you have to pay it back in 3 months. It might not work for you. But taking something back like the startup loan that we spoke about earlier, that's at 6%, but over 5 years, you're only paying back £500 a month. That's huge different to what you could be paying back at thousands of pounds per month. So thinking about what you're taking on is really important. There's invoice finance as well. So for the B2Bs out there, invoice finance is a really good way for dealing with larger companies that take forever to pay you. It is a bit more expensive, but it really does work with your cash flow. That's what it's for. It's about your cash flow. So if you're Phil again, because sorry, I don't know everyone here today. Sorry, Phil, pick on you. Good example. So if Phil suddenly lands an order from John Lewis, for example, and he now has to produce that order. So he has to go and pay his £6 a unit for his 500 units. He then has to land them. He then has to deliver them. And he now has to wait for that payment to come in. John Lewis happens to be a 7-day payer. But what about if it was Aldi, who pay you in 90 days to 100? Now that money is out the door for all that period of time. So think about cash runway. So you pay your supplier, it lands in the UK, you deliver it to your destination, then you wait to get paid. How long is that journey? So how long is your cash flow out the door before you get it back in? Now, if you're really popular and they order a second time within a week or 2, you then have that process all over again. So how long is that money out for? So how long can you survive? Can your business survive that journey from order to payment? That's the question you should be asking. And if it's, I can't survive very long, then I suggest invoice finance is something that you should look at. Because what happens is on delivery, you invoice, you get paid. And now you can have some cash flow and do the same again. So the idea would be you would want to look at yourself on a 3-year plan and try and manage yourself out of that invoice finance line if you can, by keeping your own cash within the business or getting better terms. But it's a really interesting way of doing stuff. And it doesn't mean you're in distress. It just means you're not the person's bank. Okay, you're not their bank. And they treat you like a bank, some of these, because they just don't care. I had one client who phoned me the other day and said, I'm slightly stuck. I'm owed 100 and something odd £1,000 from X supplier. They sent my invoice back and had it all again because I made a spelling mistake and they wouldn't accept it. More days on something they'd already paid for and now have to wait more days for. So your customers are only your customers. They're not your friends and they don't treat you as such. So it's important to think about those things. I'm going to quickly talk about what lenders look at. And I think this is something that is all about pre-preparation. I get people coming to me and say, I need money in 3 days' time, which can be done and it's absolutely fine. But what happens is something crops up, something isn't right, something is not as good as it could be. We have no chance to change those things. And so what happens is rather than going to lender A, which is less expensive, we end up at lender C, which is more expensive because we don't have any time to make any positive changes. So these are the things that the lenders look at. They look at business credit scores, and I'm happy if anybody wants to contact me to download your business credit scores and send them to you so you can have a look and see what they look at. They also look at directors' credit scores. And I know everyone says, I'm a limited company and it's lending to my company. No, lenders are lending to you. They are lending to the directors of the company. That's how they view it. What you think and how they view something is two different things. So it's important. So downloading your Experian report, making sure it's all lovely, making sure you're not utilizing too much of your credit, making sure there's no anomalies on there at all, making sure that you're even on the electoral roll, that can have a problem at KYC if you're not on the electoral roll. And making sure all those little things, personal things, are all in place. Making sure that there's no markers on your credit file, making sure there's no missed payments. So if you've got credit cards, put them on a minimum direct debit every single month so you never get a missed payment, and then you can overpay it later if you want to pay it off. But if you can do nothing else, do the minimum, because you can never be late if you do that. And having that, so what they're doing is they're looking at you saying, well, how do you conduct your life? What do you like? Because if you conduct your life like that, you're probably going to be reflective of that in your business life. And that's why they look at us quite closely as directors. The other thing to look at is conduct on your business bank statements. And I know it sounds a bit crazy, but what a lender will do is get your business, used to be manually, now it's all done by AI, which is fabulous. But what they do is they quickly scan your bank statements and they go, how many times in this month can you not pay us? And that's the question they ask. So if you're buffering either against the end of your overdraft, or you don't have an overdraft and you're going over a little bit and just getting late payments, that's going to be less likely an approval for you. So they're less likely going to lend to you or lend to you the money that you want to borrow. And that's important to look at as well. All those things will help. The other thing a lender looks at, rightfully or wrongly, some lenders will not lend to you if you're not a homeowner, or will be restrictive of the lend to you if you're not a homeowner. So it's important to make sure that the lenders you're going to, you understand what their minimum criteria is for the lend. So there's no point wasting your time going to all these different algorithms, putting your details in, getting a credit check, and failing because actually they'll only lend 25 grand to a tenant. So it's important to understand those little bits about a lender and how they will lend. But doing all those self-checks and all those self-checks on your business to start with can be really positive and make sure that you have a really positive outcome and look at that. So, and that goes for everything, every single lender across there. And the other question that you need to ask yourself is, are you doing it based on recent historicals? So if you're a business over 3 years, you can go to a lender that just will look at your recent historical financials. I don't know why they do that particularly, because it doesn't mean nothing about the going forward, but they look at your recent conduct, they look at how you've been doing, and they'll just lend based on that. Other lenders will look at that, plus a cash flow forecast. So if you've got some contracts dipping in, so Phil's got £100,000 a month coming in, and he's just won another big contract, some of the lenders won't take that big contract into consideration. So you have to make sure you're going to speak to a lender that's not an algorithm. An algorithm can't understand you. But some of the lenders and some of the cheaper lenders will work off that and put that into account. So I think that's an important thing to note and think about before you go for funding. The other thing just to consider is if when you get offers, and I'm going to keep this fairly short because I'm hoping there's some questions, is understanding how the lender is charging. So you have got 2 offers, and one's at 5% and one's at 8%. Don't be fooled that the 5% is cheaper than the 8% if you don't know what the 5% means. Because if it's a 5% flat rate, it's more expensive than the 8% interest rate. The other thing to ask is a repayment schedule. So you can also see how the loan is being repaid. Is it upfront, is it like a mortgage, an upfront interest heavy? Or is it an equal payment throughout the time? The other questions to ask is, can I overpay and can I repay early, and can I save on interest without penalty? So if you go into an asset finance lender, for example, you are less likely to be able to, you can repay early, I apologise, but you will not be able to save on interest. You will pay for the whole deal that you've signed up for. So you may think to yourself, well, actually, the asset finance isn't going to work for me there because I can definitely repay this within 18 months because of the contracts coming in. So a loan might be more appropriate than asset finance. If you've got absolutely zero intention of repaying early, then you might say to yourself, well, it's cheaper on asset finance and therefore I'm just going to run the term. And you're happy with that. So all these little questions to ask yourself before you raise any form of applications, looking at any form of finance. So is, what do I need? What do I need? Why do I need it? How much do I need? And I mean that genuinely. And people say, oh, £100,000 or £200,000. No, genuinely, how much do you need? Is that enough? Because if you borrow too little today, and in 6 months' time you need a lot more, it's harder to get in 6 months' time. But if you borrow too much today and you can't repay it early, or it is not affordable, then that's also going to have a negative effect on your business moving forward. So often we have very long conversations about exactly how much you need and how often do you need it. Because if you need cycling, then you need an overdraft, something that's a credit facility or an invoice finance line. If you need something that's a bit fixed, so anything that can't be liquidated, that's kind of the way I think about it. So marketing, valueless to anybody else but you. People can't be liquidated, although sometimes I wish it could be. It would be nice, but so so people can't be liquidated. So if you're hiring, they have no value to anybody but you. All those things, advertising, stock actually has no value really to anybody but you. So if you're buying big lumps of stuff or using something and you're using the money pretty much immediately, if you're doing an acquisition, a merger, doing an MBO, MBI, anything like that, then a loan is probably exactly what you need. But it could be run alongside asset finance and it could be run alongside invoice finance to give you the whole suite. So always question yourself, what do I need? How much do I need? How long do I need it? What's going to happen in 6 months' time? How much are they going to charge me? Those are the questions you need to ask. And am I with the right lender? Do your research. Make sure you understand. If you're not sure, ask for their T's and C's up front. because some of them have hidden T's and C's, because we're all really crazy as business owners, because I know people who will just sign stuff without reading it. And I think you've got to read the stuff first. So someone like Funding Circle, which you all would have heard of, actually won't allow you to take funding outside of Funding Circle without their permission if you have a loan with them. So if you're going to take a loan out with them, you have to be really sure that you either don't want money or you're happy to go back to them for more money later. Okay, so it's really important that you just understand those little nuances and ask the questions before you go ahead. I think that is my whistle stop tour, and I'm probably almost out of time. So is there any questions? I've done a lot of talking.
Well, that's been fabulous, Sharon. Thank you very, very much. The whole purpose of this is basically, we deal so much with how do I get finance for my business? What is the most efficient way? We all know what's happened with the funding market at the moment, and that's why I want to give founders as many options as possible, alternatives. So I think that's important.
Yeah.
Nadia.
Thanks for that. It was really, really useful and very engaging. So just to tell you a bit about my business, I have a website for dog owners where you can book venues to go with your dog experiences. So the community is obviously huge for me. You know, having a dog is it's like a cult. We all stick together. Crowdfunding for me, especially because I follow Brewdog quite a lot and what they did and so on, would be great. The biggest problem is I've done my first round. I raised friends and family, and then when I decided to do crowdfunding, you still have to get some commitment from a lead investor.
Correct.
And that's my struggle at the moment, is just trying to find a lead investor to then. But I know that in America there are ways to crowdfund without a lead investor, but as in to just crowdfund.
Yeah, there are, and crowdfunding is always so difficult. And I think with the crowdfunding platforms, a few things to be aware of is if you go to raise £50,000, for example, and you only raise 48, you don't get the money. So it's almost, in the nicest way, set your sights low. Mm-hmm. And go over the top so you get that money. So the money will be released to you. That's really important. That's number one. Your lead investor could be you. Okay. So you can actually put your own money in and say, fine, we're a lead investor, we'll do it. The other thing that you can do with your lead investors, you can go back to your friends and family and you can say, I need your help again, but I'm going to give you your money back.
Oh.
Because once you get the money, think about the tax implications around those and have a chat with your accountant, because I am not a tax advisor, I'm not an accountant, and this is not advice, but it is something that you can look at. So you can, once you get the money, what are you going to do to it? The other thing you can do is go out to your partners. So you've got a website, you said. So whoever's built your website, can they be your lead investor? Because all you'll say to them is, I'm going to reinvest twice that money back with you for my website improvements once I get this. So they can effectively charge you double so they can get their money back really quickly. So there are lots of ways. So you can look at going to suppliers and, dog food suppliers, so like handmade dog food people, that type of thing, and say to them, I need you to be my lead investor, but I'm going to give you all this free advertising. And you're going to be here, here, here. So for your investment, I'm going to give you all this. This is the package. This is the value. And that's how you can build your lead investors to start with. It's very much based on relationship, but you can forge those relationships, fairly quickly, and there are ways of getting that money back. I'm pretty sure you can use a startup loan as a lead investor. If you go for a startup loan, though, you have to be buying something. Okay, very important. So you have to be buying something. You cannot be using it as working capital or as seed capital, technically. So let's say you're buying website improvements, advertising, Google advertising, etc., and you've got 20 grand, you get the money is paid to you as the director, and then you loan it to your company.
Okay.
So you can loan it to your company to be the lead investor, because nobody checks what happens to the money after.
Wow.
Okay.
Brilliant. Thank you.
But you don't tell anyone that last bit.
Don't worry.
Okay,
it
good.
stays between us.
The chat in the house rules, right? Yeah, all good.
Thanks, Nadia, for your question. Any additional questions for Sharon this morning? Anything anyone would like to ask? Gareth?
Yeah, thanks, Sharon. Sorry I was off cam for a bit of that, but it was a really, really great whistle-stop tour of all of the options that are available. You mentioned your opener was with the British Business Bank's startup loan company, which is underused. But you mentioned about per director, the 25k per director. Could you elaborate a little bit on that? For example, are the directors required to give personal guarantees?
So yes, so it's up to 4 directors, £25,000 each. That's really hard to get. So I'm just going to take a step back. It's really hard to get, and they might end up doing that in tranches, which is perfectly understandable. This is taxpayers' money, so they have to be a bit careful out the door. You also have to be buying things with that £100,000, so it can't be but just used as working capital or paying your wages. So really good for setup costs. And I think stock, it is minimal. I think it could be something like 10 or 20% stock, so it can't just be for things like that. Yes, it's a personal guarantee. It is a personal loan to the directors, and therefore you are personally liable for that loan and that repayment of that loan. I have to say, in my experience, if people have failed in their business, because business failure happens, they try and get you into a payment plan, and they're pretty gentle about it, if I'm honest. There's no sort of taking your home or anything crazy like that. They will just try and recover some of the money where possible. I mean, if one really wanted to, there is personal guarantee insurance available now. You can insure anything. I think the moment Beyonce's insured her bottom, I think you can pretty much insure anything. But you can insure your personal guarantee now. It's quite expensive, but probably not so much on a 25 grander. And it's a business expense. You could technically use that as part of your application to pay for the startup loan, to get the startup loan. Personal guarantee insurance, again, it's regulated. So I'm not going to give you any advice, but it can cover up to 80% of the outstanding capital. They give you up to 10 grand's worth of money to help fight your corner, tidy things up, that type of thing. So yeah, it's a worthwhile consideration, but the startup loan, I don't know if it's that important.
I can imagine with lots of people in our community that are pre-revenue that maybe don't want to keep giving away chunks of their equity. It's a worthwhile consideration, especially if you can hedge against the risk to some extent. Yeah,
definitely. And I think pre-revenue still means you have to afford to repay it though, Gareth,
of course. Yeah.
And that will come out of your own coffers. But I think it is a really good way of getting yourself to revenue making positions.
Yeah. No one should be borrowing any money or raising any money from investors if they don't plan to actually drive revenue and return profit at some point.
Exactly.
Thanks, Gareth. Have you got any details we can share?
Yes. Do you want me to put them in the chat?
Just say you email them over to me.
Yeah, I can email them over to you.
Yeah, that'd be something that we would like to distribute amongst the community.
Did you want startup loan details as well?
Yes, please. Yeah,
that's absolutely fine. We can do that. Just with the startup loan, I think it's really important to note, before you do any work on it, you have to pass the credit check. If you don't pass the credit check, then you're not getting the money. That's simple, I'm afraid. And you really, I'll send you everything, but you really need to be prepared, because the moment you have to start going backwards and forwards, we're okay because we get straight in with our delivery partners. We work with 3 delivery partners. But if you're, I don't know where you'll end up. You can end up anywhere. And the moment they start asking questions back and then forward, you just get put to the back of the queue. So it can take in excess of 10 weeks.
Understood.
Okay.
Gideon.
Thank you, Sharon. I just really wanted to say thank you, and you come across really well. And I'm not in the kind of mode of thinking about borrowing or financing, but if I am, I'd like to have a chat with you. So, is there a good way to keep in touch? Is LinkedIn the way? Is it?
LinkedIn, or I can share my contact details, website. I can share all that. I can just I should have put my LinkedIn on here, shouldn't I? But I can just give you my email. I can remember it. I feel under pressure now typing, you see, while you're looking at me.
I'll find you on LinkedIn.
Yeah, that's my email address. So that's possibly one of the easiest way to get hold of me. But LinkedIn, of course, is all there. Oh, I might just direct message that to Maureen. Sorry, how did I manage that, Maureen? No idea. How do I change that? Everyone, there we go. There, should be there now. Okay.
Thanks, Gideon. Thanks, Sharon. Thanks all. Any last question? One last question for Sharon while she's with us this morning?
Oh, I've baffled everyone.
You've
Talking too much.
Exhausted all the questions. It's been fabulous.
Could you tell us when interest rates will come down?
They might go up a little bit before they come down. Sorry, Gideon. I know, sad times. It depends. And the next announcement, if it stays the same, it will come down, but probably not immediately. If it goes up, then we've probably got another 6 to 8 months of it being at the same level. But it will come down. What goes up must come down. All is well. Don't panic.
Thanks, Sharon. Thanks, Gideon. It's been fabulous this morning, Sharon, and I really appreciate you coming on.
Appreciate the invite. Thank you.
You're welcome to join our community anytime. Any updates, any new products, anything on the horizon, just come on and let us know, please.
Of course.
It was really good. We'll share the video with you.
Thank you.
And we're going to get a lot of love and appreciation and big ups on LinkedIn today and various other platforms. But that was really, really good.
Thank you. I really appreciate being invited, and thank you everyone for your time. I know it's precious, so thank you.